Welcome back to the Chiro Money Show, where we're helping chiropractors make better financial decisions so they can build stability in their finances and a lifestyle that they love. We're your hosts, Chris Shield and Scott Campbell, financial planners with Align Wealth.
Welcome in, Chris. How are we doing today?
Doing good, Scott. How are you?
Good. Doing good.
Yeah, you had a good weekend, eh?
Yeah, a really good weekend. I was out in Toronto taking part in the AFC Spring Conference, their day-and-a-half event out there. Awesome conference. Got to meet with a lot of great chiropractors, had some great conversations, but best part that I always love to do is sneak in the back and try and take part of hearing some of the speakers. And I get a little bit. I don't get it all, but I get bits and pieces, and I always enjoy that part of going to these conferences.
So always fun.
Yep.
Cool.
Ready to dive in?
Yeah, ready to dive in. Trying to close the loop here on investing, hey? Episode 3 of our probably 3-part series on investing. Yeah.
This should be the last one. Yeah, we planned it that way.
It won't be like the final. Like, we'll always be talking about this. Like, it'll continue to come up over the years, assuming we're going to be podcasting for years. Hey, Scott.
Lock it in, Chris.
Yeah, lock it in. Okay. What do you want to say before we dive in here?
Yeah, so we probably should have mentioned this in episodes 1 and 2, but even more so today as we talk a little bit more about the philosophy that we really have a lot of conviction in, that we implement with our clients in terms of how we put together their investment portfolio. This episode and everything we're talking about today, this is all just for educational purposes. This is not specific investment advice. So we're going to be sharing a philosophy, but at the end of the day, you need to be talking to a qualified financial advisor, your planner, who knows you and your situation before making any changes to your own portfolio. All right, Chris, why don't you get us caught up? Obviously, if you haven't watched or listened to the first 2 episodes of this mini-series, we encourage you to go back and check those out, because it'll tie this 3rd episode in much better, of course. But Chris, why don't we kick things off with just doing a super quick recap of what we talked about in those first 2 episodes of this mini-series we're putting together.
Okay, so episode 1. We talked about traditional active management, which is still the most prevalent, most common way that most Canadians are invested. And what we discovered in that episode was that, about only 2% or 2 out of every 100 Canadian equity mutual funds beat their benchmark over a 10-year period of time. And there's so much data, specifically the SPIVA report that goes into this every year. And the data has been very consistent over the years. So actively managed mutual funds tend to underperform over the short and long term. That was episode 1.
Only thing I'll add there is, with the 2 other things to remember, this is very similar story for U.S. equity funds, international equity funds, and the stats are right now in Canada. If you are an investor, the stats are saying that roughly 3 out of every 4 Canadians right now are invested into actively managed funds.
Yep. All right. So then episode 2, we said, okay, well, if active management doesn't work and it's a losing game. So why bother? What's the alternative? And most common alternative is this big movement into passive. And maybe that's, another way to say that is an index approach to investing. So rather than making all these active decisions about timing the market and whatnot, we're just buying a fund that mirrors a certain index or a certain market, if you will. And when we talked about that, we looked at a few interesting dynamics there and how indexing is a big improvement over active management, but there are some downsides. And even with this passive approach, there are still a lot of active decisions that need to be made both at the fund level and at the personal level of the person that's purchasing these index funds. Anything I missed there in episode 2, Scott?
I don't think so. I think you hit it. At the end of the day, I would say that you're more than halfway there to right. Like, you're 80 to 90% of the way there. We have no issues with someone taking the approach of investing into index funds as their primary strategy for growing their portfolio over time. What we're going to be talking about today is just essentially a kind of a third door, an option to say, hey, but can you do better than just being purely passive? That's where we're going to dive into. But there's also going to be some caveats to the strategy that we're going to be talking about today as well. So it's not saying this is a must avenue that you need to go pursue, because indexing can still be the right fit for some people, right? So we had to say that right up front. Would you agree?
Yeah, for sure. Yeah, it's so tough, right? Because like you mentioned in the lead up here, like we have so much conviction in this strategy. There's decades of academic research, which we'll get into a little bit more detail. So why not go out there and say everybody should be doing this? Like ideally, that's kind of how I want to approach it, is saying that, like, hey, if you're an investor, you have money to invest, you should be investing this way. If there's a better option that's available to you, why not take that? Even if it's just a slight optimization compared
Yep.
to past. But like you say, Scott,
I'll come back to your point, Chris.
yeah,
Because I 100% agree with you. I do think this is, again, something that's backed by the data and the research that's why we have this conviction that we do. I'm with you, Chris, of course. Like, I do believe that this is a very optimal way and a very sensible way to invest over the long term. But there are some caveats that I want to at least touch on in this episode to say, it is different than being in a purely passive index fund. And we're going to talk about what those differences are. And if you can't handle those differences, then this wouldn't be for you. Even not to say that it's not optimal, but it might not be for you for reasons that we'll get into here later in the episode.
yeah, for sure. Okay, so let's set it up. What are we talking about here? This is door number 3. This is not active, not purely an index or passive strategy, but essentially this is an approach to investing that uses all available market data and a systematic approach to investing with the goal of targeting higher expected returns over the long term compared to a broad index.
Which is generally speaking, when you're invested in a broad index, you are in what's referred to as more of a market cap weighted approach. So if you own an index fund, there's varying sizes of companies in that index. And generally you own a portion of certain companies based on the size of that company. So as companies grow larger in size, say just for simplicity, if it's an index fund that matches the S&P 500, there's some very, very large companies at the very tippy top of the S&P 500, referred to as the Magnificent Seven right now, like your Metas and your Nvidias and Apples. They take up a very large portion of the largest 500 companies in the U.S. So as they grow in size, you have more and more exposure to those 7 companies and a proportionate weight of the companies that make up less of the S&P 500.
Yeah.
Right. That would be referred to as a market cap weighted approach. And the same thing goes for geography and different types of companies around the world.
Yeah. Just to give you a quick example, say if Apple today is worth, I have no idea. So let's just say Apple's worth $1 billion, and then Apple grows to be worth $2 billion a year from now. Their market cap has increased, and the percentage of your ownership of them through your S&P 500 index fund has increased.
Yep.
Whether you like it or
Apple's
not.
worth, we're multiples of that, Chris. Apple's worth about $4.5 trillion right now. Just because you're a little off, we had to make sure that we were clear. Apple's worth a lot more than that. I think they're worth more than the entire collective of Canada's
Stock market.
stock market. Maybe
Yeah.
Nvidia has taken that place, but they're both up there, both
Yeah.
close.
Yeah. Shows how much I know. I really follow this closely. Yeah.
Yeah, we're not in the weeds following the specific prices of Apple and Nvidia on a day-to-day basis.
No.
That's for sure. Yeah.
Yeah. Okay.
Okay.
So what's the science behind this? What talk us through it, Scott?
I think we should start with the back up and start with a belief here that I think we would want everyone to collectively say, like, yeah, that makes sense. And that is that markets are mostly efficient. The price of a given stock, the price of the market in general, no one person can accurately predict where the price of a stock or the market in general is moving at any given time. However, what the data and the research evidently shows is that the collective wisdom of every buyer and every seller around the world at any given time, their collective wisdom determines the price of a company or the stock price or the market in general, or at least very close, right?
Yeah. Wisdom and information. I think all available information that's available, everything that exists out there, the market has already taken into consideration when the price of any given security or company or stock, whatever we're going to call it, is picked. And that changes based on market information or consumer sentiment or buyers and sellers in the market.
Next would be when it comes to two primary ways you can invest. You can invest into companies around the world, known as stocks or equities, and you can also invest into bonds, fixed income. It's fair to say that most people would expect that if they take a higher risk and invest into stocks, that they're going to have a higher expected return by taking on that risk over a longer period of time than they would into more fixed income, bonds, cash, T-bills, that kind of thing. So much like we have that awareness that we have that higher expected return by investing into stocks over bonds, it's also known that companies around the world, different stocks, also have different characteristics that have different expected returns over longer periods of time. And that's really what the core of what we're going to be diving into and talking about today as it relates to this different approach to investing. So Chris, why don't you lay it out for us? What are the three reasons that certain stocks have these different characteristics that have historically delivered higher expected returns for investors?
So let me just start by sharing the three different areas here. Okay. So value, profitability, and size. These are the three characteristics that have been proven to have higher performance or higher expected returns over the long term. Okay, so let's break it down one at a time. So value. This is simply looking at the relative value for a company versus what they earn. So if we have a company with like the same future cash flows, so like two identical companies, and they have similar earnings, similar expenses, etc., they have the same expected future cash flow. The one with the lower price, i.e., better value for what you're paying for, is going to have a higher expected return. Pretty intuitive, right? Next, profitability. Again, this one's pretty straightforward as well. If there's more profit, i.e., more cash that's available for shareholders, more cash for at a given price is going to equal to a higher rate of return, higher expected return.
Yeah, for sure.
And then lastly, on the size dynamic here, smaller companies tend to carry higher risk. So the market pays you more to hold them. It's back to that simple risk return matrix that you mentioned earlier, right? Like not all asset classes, i.e. stocks versus bonds versus GICs versus a bank savings account, not all of these have the same risk tolerance. The more risk you take, the higher expected return. And if you believe that markets price risk fairly, that's why you would own equities or invest in companies in the first place. So if you already believe that that risk reward trade-off is true, we should probably apply that same logic to these three factors, these three premiums that we can tilt our portfolio to, and in doing so, be rewarded for that risk that we're taking.
Yeah, I think you laid that all very nicely for our listeners, Chris. They are, again, different characteristics. All these different companies around the world all carry different levels of risk based on, are they a growth stock or are they a value stock? Are they high profitability or are they low profitability? Are they a mega cap company like Facebook or are they a small company that we've never heard of? Intuitively, sometimes we think that we always want that exposure to the biggest companies around the world, but it's actually the reverse, that over longer periods of time, we've seen that these smaller companies that do carry more risk deliver higher returns. And we want to look at the evidence and the research and the data to say, yeah, it's all pointing us to this direction of saying we want a little bit more exposure to those areas of the market in our portfolio, and which in turn should generate some higher expected returns over the long term.
Okay, now that we've covered these three different factors, this leads us very nicely into the implementation side of things. And it only makes sense here that we need to introduce dimensional funds. So Scott, why don't you tell us about dimensional and what they do differently?
Yeah, I'd agree. Probably a great spot to introduce dimensional fund advisors, known as DFA. So dimensional has been around for, I believe, just over 40 years, 42, 43 years. They are probably the largest investment fund manager that you've never heard of. They're just crossed over $1 trillion in management globally in early 2026. Dimensional has one very, very clear investment philosophy, which is obviously we're going to be talking about how it's tied so closely to these three factors or premiums in the market. And that's what the whole investment philosophy has been built on. What I really respect about Dimensional is that they've been around since about 1981, 82. And in the early days, they recruited some really, really smart people onto the team to support diving deeper and understanding the market data. Like it's like the scientific approach to investing. So they have a team of a number of different Nobel laureates. But the interesting thing about Dimensional is that a lot of these Nobel laureates that are on the board of directors and give counsel to Dimensional, they were on Team Dimensional before they got their Nobel prizes. I'll talk specifically about Eugene Fama. He's been working closely with Dimensional for a very long time. And again, he kind of goes back to, he won his Nobel Prize on talking about the collective wisdom of all the buyers and sellers around the world. They collectively, with all that information, they determine the price of a stock, right? But he's also, along with the rest of the team at Dimensional, they understand that there are these characteristics of the market that we've gone through, the value premium, profitability premium, and size premium, that they want to tilt their portfolios towards these dimensions to give their investors that higher expected return over a longer period of time.
Yeah, it's pretty cool what Dimensional has done over the years. They have really been the leaders in this field of academic research and applying that to an investment philosophy, creating a portfolio or a product that executes that philosophy. Done years and years of research on the different premiums you mentioned, value, profitability, and size. And all of this research goes back to showing that if we can tilt towards these factors, we can have a higher expected rate of return. So it's just, yeah, it's really cool to learn more about Dimensional over the last few years here and see how they take the academic research from these very smart Nobel laureate prize winning individuals that are part of their team for the long term, have so much conviction and belief in this strategy and this philosophy, and it just runs so true and like authentic and honest throughout their whole team. Like anybody at DFA that we have ever interacted with, there's no wavering. It's like, this is the philosophy. This is the investment strategy. We all share the same belief about this, like all across the world, over their offices all over the world with Dimensional.
I heard a peer of ours on a podcast talking about active management in a bit more detail, about how early in his career he would intentionally see as many active fund managers as he could. And what he expressed was that they were all really, really smart people. The stuff that they were doing to try and have that edge and try and outpredict the market, essentially to give their investors a higher return than the market, he was impressed. But what he did say was that there was never a conviction on the process, on how they invested and how things changed year to year and how funds were managed differently based on maybe fund managers and the team changing and whatnot. Like he never knew what to fully expect from one of these big equity fund managers. But with Dimensional, they've stuck to their philosophy. It's been the same core philosophy now for decades. And obviously they make minor adjustments to improve upon that with new research and more data. And as their team grows and they have more access, but the core of it has been the same. And it's then easy for us as an advisor planner to understand the philosophy and then communicate and educate that down to the client level so that they understand how and why they're invested.
And it's interesting, maybe this would come up later, but I thought one thing I find really interesting is that Dimensional doesn't market directly to consumers. You can only access DFA products through an advisor. And that's done so very intentionally. And I think it goes back to that same education piece. Like every employee at DFA has that education and that belief in the philosophy and in the implementation of their products. They train advisors that want to use their products in that same belief and investment philosophy so that they can educate their clients so that the end user experience is better. They basically don't want somebody to come in and invest in their funds unless they understand them.
Sure.
Yeah.
And they've had a lot of success with that approach. It is true in Canada that right now, in order to access dimensional funds, you do need to go through a licensed advisor. in the States. I'm not sure exactly what year it was, but they did introduce public ETFs in the States, but those aren't accessible in Canada unless you're buying them in US dollar. But what I appreciate about Dimensional here in Canada and their approach to it is, in some ways, people might think, well, they're gatekeeping. You have to go through an advisor, but they've shown that that has been a successful end result for the end client, who's the investor, when they're working with a professional who's give them that education on how and why they're invested. That's where, when the rubber hits the road and markets do get scary, Dimensional, or I should say clients that are invested into Dimensional and the strategy there, they have more conviction that they are going to stay invested when times do get rough. So they have less turnover in their funds. There's less trading costs and activity on the fund level, which is also an end benefit to the client as well.
Sure. Yep. Okay, let's hit again on these three things that Dimensional does differently.
Sure.
And so we've already mentioned value, profitability, and size. These are the intentional factors that we tilt a portfolio towards. Okay, so if you can, Scott, you got this great analogy of the ice cube tray, which I'll steal. If you can imagine, the ice cube tray is every company that you are invested in your portfolio to start with. Let's just say it's a market cap weighted portfolio. Okay. And if we know that value, profitability, and size are over here, we're just going to tilt the ice cube tray. So some of the water is going to run out of the big mega cap companies. Not all of it, just a little bit of water is going to run down to the side where the value, highly profitable, smaller companies lie. And we're going to have a little bit of overweight ownership in those. We still hold all the different companies in the market, or most of them. We just intentionally take a little less weight in them. Okay, so that's the main thing that they do. Second part of this, of what they do differently, is they're a lot more flexible and patient compared to an index fund or a passive approach. Right? If we think back to episode 2, where we talked about Tesla being added to the index S&P 500 says, hey guys, we're going to add Tesla in 6 weeks. Get ready to buy Tesla in 6 weeks. Everybody lines up, buys Tesla in 6 weeks. They overpay because they have to, because the index fund tracks the market with no tracking error. That's their job. With Dimensional, they're never forced to buy a particular stock at a bad price. They have a very clear criteria. And if a company fits that criteria, they can add it to their fund. And if it's not, then they don't add it. Simple as that.
Yeah.
Okay. So very great implementation.
It goes to the say, like, in these Dimensional funds, you're invested in approximately 15,000 companies worldwide. And when we think about, say, small cap or smaller companies worldwide, it goes to your point, Chris. If they come across a certain company that doesn't meet their criteria of buying a small cap company that's profitable and of good value, then they're going to say, oh, I'll maybe have to have to wait a few weeks to buy that stock because it's not at a price that meets our criteria. But there's thousands of other good small cap companies that are profitable and of good value that do meet my criteria, and I'm going to buy them instead. And I'll just be patient for the other ones to meet that criteria, which is very different than active management. And again, very different than an index fund provider where they're mandated to buy it on a specific date, regardless of price.
Right. Exactly. And yeah, the third point here even speaks a bit further to this, is like how they integrate these different factor tilts and dimensions. So if we look at, let's just say, small cap or smaller companies, for instance, there are some small companies out there that are not worth adding to a portfolio, right? Just because they're small, it doesn't mean they're great. Maybe they're not profitable and they're losing money. Maybe they're growing too recklessly. So if we can cut out some of the small companies that don't meet the criteria, and same thing with the profitable companies that don't meet certain criteria, etc., we can increase our expected rate of return. And at the recent conference we were at, there was an example shared where basically 2 different small cap approaches, if we can exclude the small companies that were losing money and growing recklessly, it directly showed a higher return over the same asset class. Just looking at, they were just speaking about US small caps as a group, and the most recent return we were looking at over a 10-year period was 13.79%. But if we cut out the worst slice of those small companies that were losing money and growing recklessly, your return increased to just under 15%, 14.99. It was the same asset class, right? Still small companies, but a smarter design.
All right. Before we talk next about some of the caveats to this approach, how we implement this and how we think about this as it ties into financial planning, I think it's important to mention, as we've brought and talked a lot about Dimensional, is that we really have a lot of respect for Dimensional and their investment philosophy. And we have that conviction, which has led us to use their funds in our clients' portfolios. But we have the discretion at Aligned Wealth to use whatever funds and or ETFs we want, and we get paid the same way regardless of the funds that we do use. We use fee-based accounts for our clients, so we're not using funds or ETFs that have embedded commissions. So we're not getting paid directly from Dimensional. We have a preference to Dimensional because of their investment philosophy and their low on cost, much like the index funds that you could alternatively use, but we don't in any way, shape, or form get paid directly by Dimensional. All right. I think next, Chris, let's talk about maybe recent, like there's been some recent times here in the last 5-10 years where these premiums haven't performed the way we would want them to. But that's just because of the certain time period that we have been in most recently, right? So there is, well, I guess the better way to frame this when we're talking about index funds is that if you have an index fund approach, the goal, remember, of an index fund is to have what's referred to as zero tracking error. So if the broad market goes up 10%, you should be, if you're in that same approach, you should be earning 10%, right? And there should be zero tracking error from that. But when you have a intentional tilt away from the market cap weighted approach towards these different premiums or factors, you're not going to have the same return as the market cap weighted approach.
Yeah, lately I've even heard a few people bring up that, these premiums are maybe non-existent as of late. Like if we look at value, for instance from, 2017 to 2020, it was a really, really rough stretch in that period. And it's actually hasn't improved too much actually as of late. Growth companies like the big Magnificent Seven type companies are crushing it.
Yeah. And
But
doing a
that's
lot of
not
the
a
heavy lifting. Like
yeah.
they're doing a lot of the heavy lifting in a lot of people's portfolios as of late.
Yeah. Well, yeah, and
Right?
they make up 35%, 40% of a S&P index
Yeah.
fund portfolio. So
So if you're intentionally tilting a little bit of your portfolio away from those companies, it's natural to assume that you're not going to have the same return as a market cap weighted approach.
yeah, exactly,
Yeah.
which can be tough. But
Yeah.
like any strategy or investing in general, there's no quick fix, there's no guarantee, there is no, you know, we're not talking about gambling here, and we're not talking about something that's predictable and going to happen year in year out every year no matter what. If there was a strategy that always overperformed, it wouldn't be a strategy anymore. That would just be what everybody did.
Mhm.
That's not
Yeah.
the reality. The reality is there are going to be times, there are going to be years, there are going to be seasons where these factors do not do what we are expecting them to do. That's why the premium exists.
It's very
They
natural.
right. So share some of those stats with us, Scott, over like rolling 10-year periods of time over the
Yeah,
last 60 or so years.
for sure. So we have to look at the flip side. So we have to keep in mind that a 1 year period, 3 year period, even a 5 year period, I would even argue to say a 10 year period is not a long period of time. Maybe in the moment, like looking back 10 years, like it's been a full decade, but there can be decades where like you look at, for example, if we just talk about geographically, like over the last decade or so, their economy in the US has absolutely like crushed it over the last 10 years. And a lot of that has come from the fact of like these large cap growth companies have dominated in the US. But there's also stretches of time where Canada's been the leader, or I think it was in 2025, if I'm not mistaken, it was Spain who actually had the highest returns from a global perspective. So we have to keep in mind that things change year to year in terms of different asset classes performing better or worse, different countries around the world, different times. But again, if we look at the data and we look at a longer period, if we go back over the last, 100+ years, and we start looking at rolling 10-year periods, that's where the evidence starts to tilt towards saying, yeah, these premiums do show over rolling 10-year periods. And I'll touch on these that, for example, on the US equity side, profitability premium over rolling 10-year periods, 90% of the time, we're seeing more profitable companies outperform lower profitability companies. And that one's kind of intuitive. That kind of just makes sense, right? Same thing on the value side. So value companies have outperformed 77% of the time in rolling 10-year periods. And then when it comes to smaller companies versus larger companies, as of late, it's those larger companies that have performed well, but the smaller companies, rolling 10-year periods, have outperformed about 68% of the time. So that's it's not quite a coin flip, but it's obviously enough data if you go back far enough to say, hey, over a long enough period of time, I think I want to put a little bit more of my weight of my portfolio on these smaller companies because 68% of the time over rolling 10-year periods, they're giving me some outperformance. But that doesn't mean that the next 10 years ahead of us is going to give us those premium returns that we're hoping for.
But this is where we have to keep in mind, we're not just investing for the next 10 years.
Yeah.
Even if retirement is 10 years away, you're still not just investing for the next 10 years. You need to invest for the 10 years leading up to your retirement and probably 30 or more years of retirement. So you still have 40 years ahead. So why not tilt to these factors that have shown that they can get you higher expected return?
Mm-hmm. I think this is an interesting stat too that we pointed out. Rolling 10-year periods over 50 years, there's been 607 of these examples of that time period of these. We mentioned the 3 premiums, but the 4th premium is just the premium of investing into stocks or companies over fixed income and bonds. There's been 0 periods where 3 or 4 of these premiums were negative simultaneously. So at least one of these premiums is always working, but the key is that we don't want to say just be in small companies or just be in value companies. We want to have a slight tilt towards all of these different premiums, companies around the world in these 3 premiums. And we know that by spreading across these different factors over the long term is going to give us a higher expected result.
Yep, for sure. So we got to talk about who this isn't for, because there's a lot of investors out there that just won't buy into this.
Who did not before? This is what I wanted to get into earlier, right? Like this, we have conviction into it. We think it's a very sensible way to approach or a sensible way to invest. Because if we step back, before you continue on, Chris, I just want to step back and talk about this real quick. At the end of the day, when we're making a potential decision to move away from a pure passive approach, what we're essentially shifting away to is that we still want to remain globally diversified. So when we say globally diversified, we want to be invested in about 15,000 companies around the world. Okay, we want to start there because we believe markets are efficient and we don't believe that one country or asset class is going to dominate over a certain period of time. So we want to own it all. We also want to keep our costs low, much like index funds. We didn't mention this earlier, but the cost of most of these dimensional funds that we're using, they're right in line with a lot of those low cost ETF index funds as well. I think the average of the funds that we use is around 0.28, 0.30 from a management expense ratio. So nice and low, just like those index funds. The major thing that we're changing from a pure passive approach is that we want to own it all. But again, we're going to use that ice cube trade analogy. We're just going to tilt a little bit of that weight towards these premiums, just a little bit, not a lot. We still want to own our Facebooks and our Amazons and our Nvidias, but we just want to scrape a little bit off the top and shift it towards these premiums that will deliver us higher returns over the long term.
So this is not for you if you want to watch the S&P 500 and you want your portfolio to get you a similar return to the S&P 500. If that's what you're basing your results off of is benchmarking to a specific market or index, this is just not going to work for you, because naturally with tilting towards these certain premiums, we're going to tilt away from certain securities or companies, and we're going to include others that are not as part of the S&P 500, just to look at US equities, for an example. Okay. So if that's your preference, or that's your, like, what you want to focus on is how you did comparatively to a very common or specific index, this is probably not for you. That said, if you can still make that comparison, like we did a bit of an analysis this year and looking at US equity exposure in the dimensional portfolio versus US equity exposure through the S&P 500. This year, the S&P 500 outperformed due to the Mag 7s. I'm very excited to continue watching this and see what it does over the next 10 years. And to me, that doesn't bother me at all that it underperformed last year, because we know that that's part of the strategy. And over the long term, we're going to be rewarded for that. But for some people, that just doesn't sit right, and they can't handle having a different return from what the market or their friend or neighbor or brother-in-law had. So
Hmm.
it's not going to work.
Yep.
That said, we believe so strongly in this that, like, we have so much conviction in it. It's just kind of like our chiropractors that are listening. It's like, you went through all of your studies and do what you do because you love the impact you can have with your patients, and you don't treat your patients based on hunches. You use an evidence-based approach to how you approach working with that person. You control what you can control, and you stay disciplined and stick to a long-term care plan that works for the patient, because that long-term outcome is what you care about. This is the exact same way we look at dimensional and the way we invest.
All very well said. Any final takeaways that we need to leave our listeners with, Chris, before we wrap things up? I think we've hit all the primary points that we wanted to make as it relates to our philosophy and the way we're designing portfolios for our clients.
Yeah. Yeah. I'll give a few quick hot takeaways here. Okay.
Bring in the hot takes. Okay, fire away, Chris. Let's go.
This is not active. It's not passive. This is an evidence-based approach that tilts towards what has historically been proven to deliver higher expected returns. And
Yep.
that said, patience is what matters here. These premiums show up over decades, not quarters or years. The biggest risk is not implementing a strategy like this. It's actually starting it and then abandoning it at the wrong moment, just like any investment strategy.
Yeah, absolutely. For sure. For sure. Discipline and patience and having faith in the future that, I think in order to have all those things, what's I think really important is the educational piece, which we pride ourselves on spending a lot of time with our clients early in in our process of, like, we want you to understand how and why you're invested the way that we do. When markets are good and everyone's making money and returns are good, no one's concerned. Most people are staying in their seat, no problem. It's when markets do get challenging and do get roughy and you see your portfolio drop in value, that's where we need to come back to being like, I understand how and why I'm invested. This is part of the process. I have faith that we're going to get through this. I'm going to stay disciplined to my approach. It's tied to a financial plan that factors in that I'm going to have these ups and downs in the market, and I'm going to stick to it. Right?
Well said.
All right. Well, I think we can wrap it up here. This wraps up our 3-part investing series where we kind of touched on all these different ways you can invest and the pros and cons. And hopefully we did a good job here covering it. And I guess to close things off, if you're a chiropractor and you have questions about this philosophy and how we're investing and how it's tied into what we like to call real financial planning, if you're curious about that all, of how this all kind of ties together, we'd love to connect with you. Feel free at any time to go to alignwealth.ca, book an introduction call with Chris and I. We'd love to chat with you and answer any questions you have as it relates to our planning process and how this investment philosophy all ties into it. All right. Thanks, Chris. Appreciate the time. We will see you all next week. All opinions expressed on the Chiro Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.